Okay, so a piece of news just dropped that might seem kind of small on the surface, but it could be a huge signal of something much bigger. The global banking giant UBS, well, they're shutting down a couple of their hedge funds. The reason they're giving? Exposure to a major bankruptcy.
Now, at first glance, this is just, business as usual on Wall Street. A fund made a bad bet on a company called First Brands. The company went belly up. The fund is taking a massive hit. We're talking a potential loss of 30% of its value. So UBS is winding it down. It's a classic story, right? You make a bad investment, you pay the price. End of story. Just another Wall Street cockroach scurrying away.
Well, not so fast, because here's where the story gets really interesting. We learn that UBS isn't just shutting down the one fund that lost money. Nope, they're also liquidating a second, completely separate high-grade fund. And this is the part you really need to pay attention to. This second fund had absolutely no exposure to that bankruptcy. None. So what in the world is going on here? This is the real signal we need to dig into.
The real reason for these shutdowns, it's not about one bad bet. It's not about an isolated loss. It points to a much deeper, more systemic problem that goes right to the very heart of how these markets work. This is a problem not of bad assets, but of what happens when fear completely takes over.
And this quote from the source material, man, it just gets right to the point. The real trigger here wasn't the loss itself, it was the reaction to it. The key investors, these big, wealthy institutions that pour capital into these funds, they're getting cold feet. They're seeing a loss in one dark corner of the market, and now they're demanding their money back from every corner of it, even the profitable ones. And that brings us to the big, scary R word, redemptions. The easiest way to think about it is like a bank run, but for an investment fund. When all the investors get spooked and rush for the exits at the same time, the fund has no choice. It's forced to sell its assets immediately to get cash. It's not about good or bad investments anymore. It's about pure, raw survival. And this process, it creates this vicious cycle. Redemptions force these fire sales. These fire sales crater the price of the assets. That creates more losses on paper, which then scares even more investors, who then demand their money back, which leads to more fire sales. You see where this is going? It's a downward spiral that can turn a tiny problem into a full-blown systemic crisis, and it can happen fast. Now, if this whole process is sounding a little familiar, well, it should. You know the saying, history doesn't repeat itself, but it sure does rhyme. To really get our heads around the danger here, we've got to look back at the early warning signs of the 2008 financial crisis, which really started flashing bright red back in 2007. So let's rewind. In the spring of 2007, the official line from the Fed was, "Don't worry, subprime mortgage problems are contained." But by June, just a couple months later, the huge investment bank Bear Stearns had to bail out two of its own high-grade hedge funds. And what was the reason? You guessed it, a massive wave of redemptions from panicked investors. This was a critical trimmer, months before the real earthquake hit that August. And just like that UBS fund today, those Bear Stearns funds were sold as high grade. That's supposed to mean super safe, right? They were investing in what everyone thought were the top tier, safest slices of securities. The problem is, to get any kind of decent return from these safe assets, the funds use a ton of borrowed money. We call it leverage. So the real danger wasn't that the loans would go bad. That's credit risk. The hidden killer was liquidity risk. The risk that when you needed to sell, you couldn't, at least not without starting a crash. And this right here shows the parallel just perfectly. Back in 2007, the asset was subprime mortgages. Today, it's this massive trillion-dollar market called private credit, basically loans made to companies that can't get them from regular banks. The trigger back then was a cooling housing market. Today, it looks like it's a weakening labor market and even some fraud. But look at the problem. It's the exact same engine of crisis, a loss of confidence that leads to redemptions and fire sales. It's rhyming, all right? And here's the thing. This financial stress isn't happening in some Wall Street vacuum. The fuel for this fire is coming from very real cracks that are starting to show up on Main Street. The entire foundation of this private credit boom was built on one big assumption, a strong and stable economy. And that assumption is now being seriously questioned. And we're starting to see the proof. While the official government data has been delayed, private data providers are painting a really concerning picture. For example, Revelio Labs is now reporting that the economy didn't just slow down. It actually lost 9,000 jobs in October. That's not a slowdown, folks. That's a contraction. And other reports are backing this up. The ADP report, another metric that everyone watches, show the private sector created only 42,000 jobs. Now, to put that into perspective for you, that number is incredibly low. It's just another blinking red light that the labor market is losing steam and fast. And the warning signs just keep piling up. Job openings, lowest point in years. People staying on unemployment benefits, highest level since before the pandemic. And on top of all that, we're seeing this steady drumbeat of layoff announcements from major companies. See, these aren't just isolated data points. They're all part of a much bigger worrying trend.
So this is the connection you have to make. This is the crucial point. The weakening real economy is what is making investors in these complex financial products so incredibly nervous. All those private loans were made assuming the job market would stay strong. As that assumption starts to fall apart, that finger on the redeem button gets a whole lot itchier.
And that really gets to the absolute core of the problem here. This private credit market, it's notoriously opaque. It's a shadow market for a reason. There's a huge lack of public information. So when an investor sees smoke, like a bankruptcy or weakening job numbers, they don't have the data to figure out if it's a real fire. So the rational thing to do in that situation isn't to wait and see. The smart move is to pull your money out first and ask the questions later.
Which brings us right to the final, unsettling question. These UBS fund shutdowns, they're a tremor. The job market data, those are clear cracks in the economic foundation. These two events are connected by a crisis of confidence, made so much worse by a lack of transparency and a ton of leverage. And it forces all of us to ask, at what point do these warning signs stop being isolated tremors and escalate into a full-blown earthquake?